Hey everybody, Rowan Smith from the Mortgage Center. I want to talk today about private lending. There's a lot of confusion as to where it is. People often say to me, I tried to get 5% down with my bank, but I couldn't document my income, so I was wondering if you have any private lenders. And the answer is, with 5% down, no. Private lending is restricted generally on the strength of the property and the size of your down payment. Now sure, credit and income play a role. They want to make sure you know how to pay your bills and they want to make sure you have income, but they may not seek to verify in exactly the same fashion that banks will. Many times they won't look at it at all. They'll assume that if you're stroking down 30% or 40% of a property's value and that you have payments of $1,500 a month, that you would be a fool to do so if you didn't have a means of making those payments. That's equity lending. And equity lending is really based on the quality of the security, its proximity to major arterial routes, to urban centers, to schools, etc., 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 predominantly focused on resale value. So if you're buying a unique property up in the Kootenays and you're trying to get 95% financing, if the banks won't do it and CMHC won't do it, you're not going to get it from a private lender outside of the bank of mom and dad. Now, in cases where private lending is required, someone with poor credit, maybe their credit is below what the bank threshold is, and maybe they have a large down payment. A classic example of this is someone who's gone through a bankruptcy, owns a business, and maybe still makes very good money, but due to one reason or another was forced to declare bankruptcy, and they've got 30% down, and they're trying to buy a place, and they're being told everywhere that, no way, we can't do it due to credit. That's a perfect candidate for private lending, and usually they can get some reasonable rates in those circumstances, assuming the property is, again, solid and secure, because that's kind of the backbone of private lending. Another thing is if a property doesn't conform to standard uses, for example, a former grow-op, or former meth lab, or land-only, unserviced lots, and that kind of thing. These are places where banks don't really like to lend, at least not at the 4% range or 5% range. But that's still good business, and those properties still have value. So if you're a borrower looking to get some sort of a land loan or a former grow-op financing so that you can fix it and sell it for a large profit, those are definitely ones that we can help you. Lastly, people that just can't document their income. Maybe they've got fantastic credit. They run a small business and they make good money each year, but due to write-offs and tax-efficient accounting, they're not able to prove their income. And if the banks don't believe how much income they're earning, but they have a sizable down payment, again, we might have to go to private lenders. Not always. We often have equity programs at banks and whatnot if they have enough of a down payment. But sometimes there's that gap between what the banks will do on an equity basis and between what they will do on a stated income or full income basis. And in that gap is where private lenders tend to make their money. Lastly, weird situations. So banks will often demand independent legal advice for a spouse buying a home without the other spouse on title, or maybe you're trying to do an equity takeout for investment purposes in another property, but the numbers don't quite jive because the banks don't give you credit for your rental income the way that they used to. These are all perfect examples of places where private lending is required. A common one is also construction or buy, fix and flip. These are places where you can use a private lender who's not going to ask you 1,000,000,001 questions like the banks are going to ask you, and can make the process a lot easier. Now in exchange for all of this freedom, in exchange for all of these abilities, you're going to pay a higher rate. So if the banks are charging 4%, you're probably on a first mortgage looking anywhere from 6.5 to 12, depending on the risk that you pose as a borrower and that the property poses as security to the lender. Now, there's also second mortgages, third, and so on and so forth. Maybe you don't want to break your first mortgage because you've got a fantastic rate on it, but you need 20 grand to consolidate some credit card debt and get the creditors off your back. These are all ideal things for private lending. If you have a situation that doesn't fit the bank, but you've got some equity, and generally you need about 20% equity in the property or 20% down for private lending to be considered effective, then please give me a call. For the Mortgage Center, I'm Rowan Smith.